In this video, I am going to discuss about direct material variance. Direct material variance is a type of variance analysis that compares the actual cost of direct materials used in production with the expected or standard cost of direct materials. Simply, this is the difference between the standard direct material cost and the actual direct material cost. So the total direct material cost can be denoted as DMTV, direct material total variance, which is equal to standard direct material cost minus actual direct material cost. The actual direct material cost will be provided directly or it will be easy to calculate. But we need to know how to calculate the standard direct material cost. This is how we can calculate the standard direct material cost, which is equal to actual production units multiplied by the standard cost per unit. The purpose of material variance analysis is to identify the reasons for the differences between the actual and expected costs and to take corrective action if necessary. This expected cost means the budgeted cost. There are two types of material variances, price variance and usage variance. So simply the direct material total variance is equal to direct material usage variance plus direct material price variance. Now let's do an example question so you can understand what is the direct material total variance. After that we will discuss about each of these variances one by one. Budgeted production is 1200 units. Standard cost card for direct material per unit is 3 kilograms at $2.5 per kilogram. Actual production unit is 1400 units. Actual direct material purchased is equal to 4100 kilograms and the cost is $12,300. Calculate the direct material total variance. So the direct material total variance is equal to standard direct material cost minus the actual direct material cost. There is a very important point you have to learn here, which is most of the students will calculate the standard direct material cost by multiplying the budgeted production by the standard cost per unit value, which is equal to 3 multiplied by 2.5, $7.5 per unit. This is incorrect. We need to multiply the actual production units value by the direct material cost per unit value, which means 1400 by 7.5. This is the standard direct material cost. Another important thing to note is that only for the fixed overhead variance we consider the budgeted production value. For all the other variance calculations, we do not consider the budgeted production value. We consider the actual production value. Now let's calculate the DMTV. So the standard direct material cost is equal to actual production units, which is 1400 multiplied by the standard cost per unit, which is equal to $7.5 minus the actual direct material cost, which is equal to 12,300. This is equal to minus $1,800. This means this is an adverse value. We can write this value as 1,800 adverse. So the negative values will be adverse values and positive values will be favorable values. In this case, 1800 is an adverse value, which means the company have spent more than the budgeted value, which is a negative impact to the company. This is why this value is an adverse value. Now let's discuss about the direct material usage variance. Direct material usage variance denotes by DMUV. Direct material usage variance measures the difference between the actual quantity of materials used in the production and the expected or standard quantity of materials. We can use this equation to calculate the direct material usage variance. which is equal to the difference between standard quantity and the actual quantity multiplied by the standard price. You need to remember these equations in order to calculate the variances. These equations will not be provided in your exam. Just like before, there is a standard quantity. We need to use this equation to calculate the standard quantity, which is equal to actual production units multiplied by the standard material usage per unit. Like I said earlier, we do not use the budgeted production units for the calculations. We use the actual production units unless it is for the fixed overhead variance. A favorable usage variance occurs when less material is used than expected, while an unfavorable usage variance occurs when more material is used than expected. Unfavorable usage means adverse usage. For direct material usage variances, production manager is responsible because the material is used in the production in order to produce goods. The responsible person for the production is the production manager. So the direct material usage variances will be a responsible of production manager. This is very important. Now let's do this example. Budgeted production is 1200 units. Standard cost card for direct material per unit is equal to 3 kilograms and 1 kilogram is equal to $2.5. Actual production is 1400 units. Actual direct material purchase is 4100 kilograms and cost is $12,300. Calculate the direct material usage variance. So the direct material usage variance is equal to standard usage minus actual usage multiplied by the standard price. So as I said earlier, this budgeted production unit figure is not relevant to the calculation of variations. So now let's calculate the standard quantity, which is equal to actual production units, which is 1400 multiplied by the standard material usage per unit. So 3 kilograms of material will be used to produce 1 unit. So 3 kilograms. This is the standard quantity of material usage, which is equal to 4200 kilograms. Now we can calculate the direct material usage variance, which is equal to 4200 kilograms minus actual usage, which is 4100 kilograms, multiplied by the standard price, which is 2.5 per kilogram, 2.5, which is equal to $250. This is a positive value, which means this is a favorable value. This is because the actual usage of the materials are less than the budgeted amount, which means this is a cost saving for the company. So this is a positive impact to the company. So we consider this as a favorable variance. Now let's discuss about the reasons for direct material usage variances. You need to calculate the variations as well as you need to know the reasons for the variations as well. So if it is a favorable variance, these are the potential reasons. Efficient use of materials. When this happens, the wastage of material will be less. So the usage of the materials will be less than the budgeted amount. High quality materials. When high quality materials are used, the wastage will be lower. So this will reduce the actual usage of materials. Improved production methods. This will also reduce the wastage. Now you have to have the understanding of if the wastage is less, the direct material usage variance will be a favorable one because the usage of the material will be less than the budgeted amount. And finally, less normal loss. Normal loss is a loss that the management accountants are expecting in the production. If the actual losses are less than the expected losses, the direct material usage variance will be a favorable one. We can consider the opposites of each of these points for adverse variances. So, inefficient use of materials, poor quality materials, machine breakdowns, and more wastage than expected will lead to adverse variances under direct material usage variance. This means the actual material usage in the production is higher than the budgeted usage. Direct material price variance. This denotes by DMPV. Direct material price variance measures the difference between the actual cost of materials and the expected or standard cost of materials based on the actual quantity of materials purchased. This is the equation we can use to calculate the direct material price variance, which is equal to the difference between standard price and the actual price multiplied by the actual quantity purchased. A favorable price variance occurs when the actual price is lower than the standard price, while an unfavorable price variance occurs when the actual price is higher than the standard price. For direct material price variances, purchasing manager is responsible because the purchasing manager is the individual who is responsible for the purchasing of raw materials to the organization. This is really important. Now let's do this example. This is the same example as before. Now they are asking to calculate the direct material price variance. So the direct material price variance is equal to standard price minus actual price multiplied by actual material purchased. You need to take the price per kilogram. So standard price per kilogram is given here, which is 2.5, and they have not given the actual price per unit. But using these two figures, we can calculate the actual price per unit. We can simply divide the 12,300 by 4,100. This will give us the actual price per kilogram, which is equal to $3. So 3 multiplied by actual material purchased, which is equal to 4,100 kilograms. This is equal to negative $2,050. This means this is a $2,050 adverse value, because the standard cost per kilogram was $2.5, but actually they have purchased the direct material for $3 per each kilogram. This is because the standard cost per kilogram is $2.5, but actually they have paid 3 for 1 kilogram, which is an increase of price, which means the company had to pay more than the budgeted amount. So this is an adverse variance. Under direct material price variance, there are two instances. If the inventory is calculated at the standard cost, direct material price variance is calculated using the actual material purchased amount. This is what we just did earlier. Direct material price variance is equal to the difference between the standard price and the actual price multiplied by the actual quantity purchased. And the other instance is if the inventory is calculated at the actual cost. Direct material price variance is calculated using the actual material used amount. So under standard cost, we use the purchased amount to calculate the direct material price variance. Under actual cost, we use the material used amount to calculate the direct material price variance. So for that, we can use this equation. The difference between the standard price and the actual price multiplied by the actual quantity used. Now let's do the same example as before and calculate the direct material price variance when the inventory is calculated at the actual cost. So direct material price variance when the inventory is valued at the actual cost. This is equal to standard price minus actual price multiplied by the actual quantity used. The prices are the same, 2.5 minus 3. Now instead of using the 4,100, which is the material purchased amount, we have to use the actual direct material used amount for the production, which is 4,020 kilograms. This is equal to negative $2,010, which is an adverse value. So 2010 adverse. Now let's discuss about the reasons for direct material price variances. Favorable variances. Negotiating better prices. This means the purchasing manager has able to negotiate better prices for the raw materials. This means the actual raw material prices are lower than the budgeted raw material prices. Changes in market condition, which means decrease in price. Bulk discounts. When businesses buy large number of units at once, they will be received bulk discount. This will decrease the price per raw material. And on the other hand, adverse variances, increase in material costs, incorrect standard cost, changes in the currency exchange rate, supplier issues. These will be result in adverse variances under direct material price variance. As we discussed earlier, direct material total variance can be divided into two parts: direct material usage variance and direct material price variance. So, this equation will provide a relationship between each of these variances. Now, let's use this equation to the early example. The direct material total variance is equal to 1800. This is an adverse value. Direct material usage variance is $250 favorable value. Direct material price variance is $2050. This is an adverse value. So this side is negative 1800. This side is also negative 1800. You need to remember all the equations we discussed earlier plus this equation. In the exam, variance analysis will be tested heavily. Thank you for watching. See you in the next video.